Good morning from Hong Kong. I'm Aidan Gregory, Senior Correspondent at InsuranceAsia News. We're in Quarry Bay this morning at Aon's offices, and I'm joined by Pierre Vende, Co-Head of Life and Health Reinsurance at Aon here in Hong Kong. Welcome, Pierre. Thanks for joining us this morning.
Yeah, you're welcome. Nice to see you, Aidan.
We're here this morning to discuss the growth of the asset-intensive reinsurance market in Asia Pacific. This market in recent years has emerged as a fast-growing corner of the reinsurance industry, particularly in Japan, which is about to transition to a new capital regime. What's driving the significant deal flow that we've seen in the asset-intensive reinsurance market in the region?
Look, so in my opinion, there are some fundamentals, right, as a reflection of demand and supply. So obviously on the demand side, it's some well-known drivers for some time, right, are the fact that within Asia Pacific and in Japan in particular, there have been a history of life insurance companies selling, long-term life product savings with high guarantees. A lot of these type of products on their balance sheet. There's a demand as well for, new retirement products and, policyholders, people like product with guarantees. So the balance sheet of the life insurers are obviously loaded with these type of capital intensive products and liabilities. And with the move that's been engaged for some time now around looking at values of life insurers and their portfolios through the lens of economic value, there's been on the demand side a force that drives life insurers to optimize their capital base. So all these factors have been driving demand for solution, and that's being met with other forces on the supply side where you have a lot of players, mostly from North America, that have been either traditional reinsurers or reinsurance entities that have been set by asset managers or private equity backed reinsurance entities that have something to offer, which is the appetite for asset risk that they have, specific capabilities in terms of investments, asset sourcing. They do have platforms where they can grow at scale, the business of onboarding life insurance liabilities and have ALM product pricing capabilities that makes them in a position to offer a competitive solution for this type of life insurance liabilities. So it's really a reflection of supply and demand. There's a process, right, over time in the last few years in Japan and in Asia Pacific. I think there's the element that more and more insurers are seeing some of their peers doing those type of transactions. So there's an element of mimicry or being able to see that it's feasible. I think there's also the fact that do this type of transaction, you need to have a good understanding of the mechanics of the transaction, how it's feasible, and as more and more transactions are being done, the entire ecosystem of life insurers, reinsurers, advisors to these transactions, more and more people are capable of, there's an increased awareness and understanding of these type of transactions that are making the flow of transaction, being able to be sustained by more people being able to engage it.
How big is the pipeline of liabilities in Japan that could be reinsured via the block life market over the coming years?
It's hard to talk about a pipeline, but just to give maybe some figures for context, right? So, more or less, right, the total amount of life insurance reserves and corresponding assets, right, on the Japanese life insurers balance sheet is somewhere close to 2.5 to 3 trillion US dollar, right? Maybe an estimation of how much of these liabilities or reserves have been reinsured in the recent years, right, through asset-intensive reinsurance. Maybe the number there would be around 100 billion, so 0.1 trillion, right? So we're talking about 1, 2, 3% of the total reserves that's been reinsured in the recent years. But it's still a relatively modest percentage, right? 1, 2, 3%, even if these are big amounts. And you can compare that to the US market where, again, if I'm not wrong, the US market currently, when you look at total life insurance reserves, there's about 40% of these that are reinsured, right? So you can imagine, the pipeline or the potential moving from a couple of percent to 40%. That's huge. But I would not expect Japan market to follow exactly the same path as the US for maybe quite a few reasons. One would be the fact that fundamentally the underlying liabilities in Japan are, the bulk of it are in Japanese yen, right? So there's there's a limit, in my opinion, to how much of these JPY denominated liabilities can be, taken by, overseas reinsurers who would have a significant portion of the investments in non-JPY denominated assets, namely USD in particular.
How well prepared are Japan's life insurers for the arrival of the country's new solvency regime, which comes into force this month?
I believe the industry overall is well prepared. I mean, these type of changes are being planned in advance. So I think in terms of how Japanese life insurers are coping with it, of course, they still need to onboard the systems, but I think many companies have anticipated that change. Don't see necessarily that, specific time of, starting in April would have a sudden or brutal impact on the reinsurance activity at large or the asset intensive reinsurance in particular. Again, many life insurers were already looking at their own balance sheet from an economic value and risk-based perspective. But there could be some more steady or progressive changes. For instance, I mean, maybe more than the change of the solvency regime, capital solvency regime as such, like we've seen in other markets, jurisdiction in Asia or in Europe, for instance, some of the life insurers will look at lapse risk as a potential driver for reinsurance solutions. So we're talking about mass lapse reinsurance solutions, for instance. And the fact that the Japanese interest rates are rising could also have an impact on more or less demand on asset-intensive reinsurance. Obviously, the fact that Japanese rates are high now means the problem of, policies that were sold 20, 30 years ago with very high guarantees. Again, like other similar regimes in the world, right? There will be a component within the, capital requirements that relates to reinsurance, which will be depending on the panel of reinsurance counterparties you're dealing with, their financial rating and the strengths of the reinsurers. You'll have different level of, reinsurance counterparty risk charge. So if anything there, that could mean there will be a benefit for the life insurers in terms of their, statutory solvency capital going forward to obviously interact and have reinsurance arrangements with reinsurers that have, stronger ratings and or be able to diversify your panel of reinsurers to mitigate that reinsurance counterparty risk charge. But in the scale of things, that's probably not as important as the more macro impact of the interest rate rising.
Some of the moves that we've seen in Japanese capital markets have been pretty extraordinary. Heading into the election and afterwards. If you look at where the Japanese 10-year is trading at the moment, it's pretty remarkable considering where borrowing costs were only a few years ago.
Indeed, yeah. No, I mean, and that volatility is something that life insurers may want to be protected against in the future, right? And that's one of the motivation to de-risk the overall balance sheet to further volatility and further movement.
We've talked a lot about Japan, but what about the rest of Asia? The region has other mature life insurance markets where these kind of deals could certainly be useful for those insurers in Hong Kong and Singapore, South Korea, Taiwan. So do you expect much growth of the asset-intensive market outside of Japan in the region?
Yes, I mean the short answer is yes. We expect further growth and relatively important growth in the other markets in the region. I mean the other mature Asia-Pacific markets where you do have sizable amount of life insurance liabilities against savings product with guarantees. The same drivers are there in terms of demand and supply, but there's a few differences. Obviously, Japan is, by far the biggest market, right? So that can draw more attention. Countries, you may have different regulatory environment, different economic situation and currency as well. I mean, among the countries you've mentioned, right, which are also most of the countries that most stakeholders in the industry are looking at further growth into asset-intensive reinsurance besides Japan. For me, at the moment, I'd see the activity, continued take-up and growth to be most likely in a market like Hong Kong and Korea. In Hong Kong, there's been a steady activity both on legacy portfolios and new business. So we see a trend in the type of transactions increasing. Korea, which had, compared to Japan, a more regulated approach, or more framework around offshore reinsurance and how to deal with asset-intensive reinsurance, which was more specific. At the moment, we've seen maybe a bit less activity in Singapore lately, but the market is also smaller, than Korea and Hong Kong. And as to Taiwan, even though very similar situation exists in terms of the potential demand for the asset-intensive reinsurance solutions, right now the market has not really started or has not really been open yet. Mostly from a regulatory perspective, with the regulator still discussing with the life insurers in terms of what may or may not be allowed.
Are you concerned about the potential for concentration risk, or is there's ample capacity available and plenty of competition to place these asset-intensive deals?
There is plenty of competition, right? So I'm not particularly concerned on concentration. I mean, some reinsurers have been, are more important than others in terms of volume of transactions they've done. But I think if you're an insurance company in Japan or in Asia, you do have access to a lot of potential different counterparties. So you can manage concentration risk by, being able to, contact and potentially arrange, solutions with a, for a pretty broad panel of reinsurance counterparties and mitigate counterparty risk, and at the same time ensuring that you've got a competitive, approach to this.
It's certainly a fascinating corner of the reinsurance market, and there's definitely a lot of excitement and interest in how it develops. I mean, these deals are they're almost like quasi M&A deals in terms of how they're structured and and how they work.
Yeah, indeed. I mean, again, there's that usual distinctions we can make between legacy portfolio, block asset-intensive reinsurance, and for some of them, indeed, they can look a bit like an M&A because you've identified a portion of your portfolio which you want to de-risk, essentially cede out to a third party. So I agree, there's an element of that that's not too dissimilar to engaging in an M&A process. Something slightly different compared to the US market, for instance, where life insurers were potentially more looking to solve the problem once and for all, and potentially with bigger transactions. The other aspect of the market that's interesting is the asset-intensive reinsurance being used for new business and flow, which is in that case not so much like an M&A process. It's more using reinsurance as a tool to keep supporting the flow of new product, with being able to offer better products, better yields to the customers. And more talking here about long-term strategic partnerships between the life insurers, obviously still developing the product, selling it, potentially still retaining a portion of the risk, and the reinsurer that will be supporting this and enabling the life insurers to have to be competitive in the market.
Thanks for joining us this morning, Pierre. It's been really interesting to listen to your answers. I'm sure as the asset-intensive market continues to grow in the region, we'll have lots more to talk about, and it's certainly, as I said, it's a very exciting space, and there's lots of interest in terms of how it develops over the coming years.
No, I agree. Happy to catch up again in a few months or in 1 year to see how the market has been evolving in the meantime. But thank you.